Okay, let's unpack this. Imagine a company, market cap under $100 million, right?
Pretty small.
Yeah, tiny. But they're involved in, like, cutting-edge AI and defense tech.
Hmm.
It just makes you think, doesn't it? In this absolutely massive semiconductor industry, can these, smaller, nimbler players actually carve out a real niche for themselves, a sustainable one?
It's a classic question, really. Can specialized innovation actually make a dent when you're up against giants with deep pockets? We see it pop up everywhere.
Exactly. And that's precisely what we're digging into today on the Deep Dives. We sift through all the noise to pull out the insights you actually need.
And our focus today.
QuickLogic Corporation. That's NASDAQ, ticker QUIK. We're going to approach this using value investing principles, trying to get a handle on the real value and, the future possibilities for this fabless semiconductor outfit.
And understanding a company like QuickLogic, it kind of shines a light on bigger trends in the whole semiconductor world, right? Especially around specialization and how smaller firms can even try to compete.
Absolutely. So what's the goal here for you listening? We're going to boil down the essential stuff about QuickLogic. Their business model, how good their management actually is, their financial shape, and where they fit in this super competitive market.
Basically save you the time of digging through piles of reports yourself.
Exactly. Think of it as your shortcut to getting smart about a pretty interesting, maybe overlooked company in a really critical industry.
And the key question we need to keep asking is, what makes them special? What are their unique strengths? And are they actually enough to overcome the, obvious challenges of being small?
Couldn't put it better. Now, our analysis, it's based on a whole bunch of stuff. QuickLogic's own financial reports, market data as of April 27th, 2025. We looked at analyst ratings, news stories, and even reports about the bigger picture, the semiconductor industry, those U.S. tariffs everyone talks about.
So the mission, then, is a clear, understandable breakdown of QuickLogic's fundamentals, and critically, the factors that are going to influence where they go from here.
Right. So first half today, we'll tackle what QuickLogic actually does. We'll evaluate the management team, and then really scrutinize the company's financial health.
And then the second half.
Second half, we'll look at how the market feels about the stock, the sentiment. We'll see who actually owns the company, and then lay out the risks involved before wrapping it all up. We'll tease a final thought for you, too.
Sounds like a plan. Let's kick off with Chapter 1, Understanding the Business. So, at its heart, what is QuickLogic?
Okay, so QuickLogic, founded way back 1988. They're a fabless semiconductor company.
Fabless meaning?
Meaning they design and market the chips, the intellectual property, the blueprints, basically, but they don't actually make them. They outsource that manufacturing part to foundries.
Got it. Architects, not builders.
Exactly. They're based out in California, and their whole thing is low-power, customizable semiconductor platforms.
Okay, so designing cool stuff, getting others to build it. How do they make money from that?
Several ways. First up is IP licensing. That's their eFPGA tech-embedded field programmable gate array.
Right, the reconfigurable bit on a chip.
Yeah, super flexible. They've got this tool, the Australis IP generator, to help create custom eFPGA cores. Plus, they have rad-hard IP.
Radiation hardened for space and military stuff?
You got it. Crucial for those environments. And they even have open source tools, Aurora. This IP gets baked into chips made using different processes, 12 nanometer, 16, 22, even older 65 nanometer tech from places like Global Foundries, maybe even Intel's new 18A process down the line.
So other companies pay them royalties or license fees to use these designs?
Precisely. That's a big stream.
Okay, what else?
Then there's product sales, selling their own chips. Discrete FPGAs, some use anti-fuse tech, others SRAM, and also FPGA SOCs. Systems on a chip.
Like more complete solutions.
Yeah, their EOS S3 platform is an example. It bundles microcontrollers, sensors, and the FPGA fabric all together. They also sell quick feather dev kits, to help engineers get started.
So building blocks and integrated platforms. Makes sense. What about software?
Right, software and services. This is mainly through SensiML, a company they bought. They have this AML platform, the Analytics Toolkit.
AI on-edge devices, TinyML.
Exactly. Bringing AI to small, low-power gadgets. Now, here's a key thing. They've said they're looking into maybe selling SensiML.
Oh, interesting. Why?
Seems like they want to really double down on their core FPGA and eFPGA business. But for now, SensiML brings in revenue from software subscriptions, per-unit licenses for AI algorithms, maybe even some consulting for proof of concepts.
Okay, so potential strategy shift there. What's the last piece of the revenue puzzle?
Government contracts. This has become increasingly important for them, especially that rad-hard FPGA tech we mentioned.
Makes sense. Defense and space applications need that reliability.
Yeah, and these could be pretty substantial development and supply deals.
Okay, so summing it up, IP licensing, selling their own chips, the AI software piece, for now at least, and big government deals. How do they stack up against the competition? Who are they really up against?
Good question. That's market position and scale. Look, QuickLogic is small fry. $84 million market cap. The semiconductor industry is, well, enormous and fiercely competitive.
Right.
They focus on niches, industrial stuff, aerospace defense, edge, AI, some consumer things, computing. But compared to the giants, AMD, now that they have Xilinx or Intel with Altera, QuickLogic is just tiny. Even compared to, say, Lattice or Microchip, they're much smaller.
So they're not trying to fight the giants head on. What's their selling point then, their value proposition?
It really boils down to a few things. Customization and flexibility, that eFPGA tech is key there. Low power consumption, which matters a lot in their target markets. They try to offer end-to-end solutions, hardware and software. Their open source approach is kind of different too. And of course, that specialized rad-hard tech for defense and aero.
So niche focus, customization, low power, and that rad-hard expertise. Makes sense.
Yeah, that's how they aim to compete.
Okay, let's pivot to Chapter 2, management evaluation. Got to look at the team steering the ship. Are they any good? Are they aligned with shareholders?
Right. Leadership assessment. Okay, the CEO is Brian Faith, CEO since 2016, but get this, he's been with QuickLogic since 1996.
Wow, long timer.
Yeah. And the CTO, Timothy Sachs, joined in 2001, became CTO in '08. VP of Ops, Rajiv Jain. He's been there since 1992.
It's a lot of institutional knowledge. Decades.
It really is. More recent additions are the CFO, Elias Nader, who joined in 2022, and the VP of IP Sales, Andy Jaros, just came on board December 2024 from a competitor, FlexLogix.
That long tenure. It could be a huge strength, right? Deep understanding. But you got to wonder, could it also mean maybe they're a bit resistant to change? Stuck in old ways?
That's the million-dollar question, isn't it? Looking at their strategic execution, they definitely shifted towards eFPGA, IP, and software. The SensiML acquisition was part of that. They have landed those government contracts, which is good. And they embraced open source to some extent. But like we said, SensiML is now under strategic review, potentially for sale. That makes you question the original strategy. Was it the right move? Did it work out as planned?
Fair point. And how has all this translated financially? For the company, for shareholders?
Well, historically, it's been rough. A long history of net losses, negative cash flow.
Yeah.
They had like one profitable quarter recently, Q4 2023, but that was just a blip. Yeah. And the long-term stock performance, pretty dismal. Plus, they did a 1-for-14 reverse stock split back in 2019.
Oof. Reverse splits are rarely a good sign, usually done to prop up the share price.
Exactly. It signals underlying problems, usually. Taking 14 weak slices and calling it one bigger slice doesn't really fix the pie.
How do they handle bumps in the road? Any major crises?
Well, there's that data security incident happened in January 2023, unauthorized access. But they didn't start notifying people until October 2023.
October? That's quite a delay, 9 months.
Yeah, a significant delay raises questions about their crisis response, their transparency.
Transparency is key for investor trust. How do they generally communicate? Any other ethical flags?
Their communication seems pretty standard, Earnings calls, press releases, SEC filings, investor website. The CEO pops up at industry events. Ethically, apart from that data breach notification delay, nothing huge has really surfaced publicly. And working in defense means they have to follow strict compliance rules.
Okay, so pulling it all together, your overall take on the leadership.
Look, technically, they seem capable. Lots of engineering experience. They can win government contracts. Communication is, well, standard. But the shareholder alignment piece is questionable.
Because of the losses.
Yeah, the persistent losses, the poor stock returns over time, that reverse split, the fact they constantly seem to need financing, which means potential dilution for current shareholders, and, this is important, quite a bit of insider selling.
We'll get to that later, I assume.
We will. And that long tenure. Again, double-edged sword. Deep knowledge, sure, but maybe inertia too. Resistance to shaking things up.
Let's stick with management, but focus on capital allocation. How are they using the company's money?
Okay, capital allocation. They spend a decent chunk on R&D, about $6.5 million in fiscal 24, which was roughly a third of their revenue for that period.
That seems high, but maybe necessary in semiconductors.
It is high, but yeah, probably necessary. They're focusing that spend on their eFPGA IP for different foundries, the rad-hard tech, and that Australis IP generator tool. Since they're fabless, their actual capital expenditure, like buying manufacturing gear, is low.
Right. What about M&A, buying other companies?
The big one was SensiML back in 2019. The idea was synergy, right? Combining their AI software with QuickLogic's hardware.
But now they might sell it.
Exactly, which again makes you seriously question that initial capital allocation. Did they misjudge the fit? Did the market change? It didn't seem to deliver the expected results if they're considering selling it now.
Have they returned any cash to shareholders? Buybacks, dividends?
Nope. No significant share buybacks and definitely no dividends.
Which makes sense given the losses, right?
Yeah.
They need the cash.
Pretty much. Retaining capital for operations and growth is probably the only sensible thing for them right now.
So the bottom line on capital allocation effectiveness, how are the returns on these investments?
Not good. Their return on invested capital, ROIC, it's consistently negative, like -7%, -8% range recently.
So for every dollar they invest in the business, they're actually losing 7 or 8 cents.
Basically, yes. It means they're destroying value, not creating it, from an investment perspective. For value creation, ROIC needs to be higher than your cost of capital.
And negative ROIC is definitely not higher than the cost of capital. That's a major red flag.
It absolutely is. Historically, their capital allocation just hasn't worked out, mainly because they haven't been profitable. R&D is vital, yes, but it hasn't led to sustained success yet. SensiML looks like a questionable use of funds in hindsight, and while not doing buybacks or dividends is right for their situation, the future really hangs on whether this intense focus on eFPGA and rad-hard can finally generate a positive ROIC. Right now, that negative number is a huge worry.
All right, let's move into the stark reality of Chapter 3, financial health. What are the key numbers telling us?
Okay, key metrics. As of late December 2024, market cap, like we said, tiny, $84.37 million. Micro-cap territory, which means, volatile stock price usually.
Here.
Meaningless right now. Negative earnings, so no trailing PE. You see some forward PE estimates out there from analysts, like maybe in the 30s or even low 20s.
But that assumes they actually hit those future profit targets.
Exactly. Pure speculation at this point.
How about revenue growth? Are they growing the top line?
Well, trailing 12 months revenue was just over $20 million. That was actually down 5.1% year over year.
Not great.
No. Quarterly results have been up and down. Q4 24 was down compared to the year before, but up from Q3. Management blamed contract delays for that and gave lower guidance for Q1 25.
But analysts are expecting growth later.
Yeah, analysts are forecasting a bounce back.
Yeah.
Over 20% growth in fiscal 25, maybe 15% in 26. But given the company's history of volatility, you have to take those forecasts with a grain of salt.
Okay, profitability. What are the margins?
Gross margin isn't actually terrible, 59.1%, though that's down from over 68% the year before.
But the bottom line.
That's where it falls apart. Operating margin, negative 17.1%. Net margin, negative 19.1%.
So they make a decent profit selling the chips, but then all the operating costs, R&D, sales, admin, just eat it all up and then some.
Precisely, leading to overall losses.
And debt, how leveraged are they?
Debt to equity is pretty high, around 0.88 or 88%. About $22 million in debt versus roughly $25 million in equity. That's significant leverage for a company losing money.
And cash flow. Are they generating cash or burning it?
Burning it. Free cash flow was negative, somewhere between negative $1.3 million and negative $6.4 million over the last year, depending how you slice it. Operating cash flow was barely positive, but once you account for capital spending, yeah, they're burning cash.
Which means they rely on
financing, external funding to keep the lights on and invest.
Price-to-book ratio. Does that tell us anything?
It's around 3 to 3.7. But honestly, with negative earnings and negative return on equity, price-to-book doesn't mean much here. It doesn't tell you if the assets are actually generating value.
So the quick summary on financial health?
Not great. Not profitable currently. Balance sheet looks weak, high debt, burning cash. Decent gross margins get wiped out by high operating expenses. That's the picture.
Okay, let's stay on Chapter 3, but look at financial stability over time. How consistent has this performance or lack thereof been?
Looking back 5-10 years, the earnings consistency is, well, consistently negative. Almost entirely net losses year after year, with just maybe an odd profitable quarter here and there.
So those analyst forecasts for future profits seem pretty optimistic given the track record.
Very optimistic. I mean, look at the last few years. 2023, net loss, $8.3 million. 2022, lost $10.5 million. 2021, lost $12.1 million. It's a clear pattern of red ink, assuming a sudden turnaround is speculative.
Dividend stability.
Not applicable. No dividends paid, which, as we said, is expected given the losses.
Right. We touched on the debt. How are they managing it? Are they strained?
It definitely looks like a strain.
Yeah.
They rely heavily on that $20 million revolving credit line they just had to amend and extend it again in March 2025. That shows they need it. And worse, their interest coverage ratio is deeply negative, like negative 8.4.
Meaning their operating income doesn't even come close to covering their interest payments.
Doesn't cover it at all. Puts a lot of pressure on them.
What about short-term liquidity? Can they pay their immediate bills?
Their current ratio is low, about 1.1 CN. The QUIK ratio, which is stricter because it excludes inventory, is similarly low. It suggests things are tight. Not much wiggle room if something unexpected happens.
So the overall assessment of financial stability.
I'd say precarious. The combination of volatile or consistently negative earnings, high debt, negative interest coverage, tight liquidity. It all points to significant financial instability. They really depend on outside funding, which is always a risk. It doesn't feel sustainable without that external capital lifeline.
Okay, that paints a challenging picture. Let's shift gears into the second half, starting with Chapter 4, Market Sentiment. How does the market actually feel about QuickLogic stock right now?
Well, the general market perception seems pretty negative, judging by the price. The stock's down significantly over the past year, like 57% to 66% down, depending on the source. Trading here is 52-week low.
Ouch.
Yeah. But it is a volatile stock. Beta well above 1, meaning it swings more wildly than the overall market. You see it pop up on trending lists sometimes, probably because of that volatility or the short interest or maybe some news about their niche markets.
Okay, so the price action is negative, but what about the professionals? What are analysts saying?
This is where it gets really weird and kind of contradictory. Analyst ratings are actually surprisingly bullish.
Bullish, after everything we just discussed about the financial.
I know, right? Across different platforms, public.com, Zacks, Wall Street's, and Fintel, Yahoo Finance, the consensus rating is generally buy or even strong buy.
That's a big disconnect from a stock near its 52-week low. What kind of upside are they seeing?
Their price targets are way above the current price. Average targets are like $9.60 up to almost $11.80. That implies, over 100% potential upside from where it is now. The range goes from $10 to over $13.
And this is based on?
Based on forecasts for revenue growth and a return to profitability in the next couple of years, fiscal 25-26. But crucially, for the immediate term, Q1 25, they still expect a loss and lower revenue year over year, and they've even trimmed those near-term estimates recently.
So near-term pain, long-term gain is the analyst view. It's still a head-scratcher given the stock price.
It really is. Maybe they're focused purely on the long-term TAC potential, or maybe analysts are just slow to adjust targets for these smaller, less followed stocks. Hard to say for sure.
What about recent news? Has anything happened lately that might be swaying sentiment one way or the other?
It's been a real mix. On the plus side, they announced some new eFPGA IP deals, including a decent $1.1 million defense contract. Got some extra funding, $1.4 million for that rad-hard program, part of a bigger $6.6 million deal. They've announced partnerships, CTD for defense, Faraday for IoT chiplets, fabless for open-source chips. They're talking progress with Intel's 18A process and integration with Synopsys tools, and management always sounds optimistic on calls.
Okay, some positive developments. What about the negative news?
Well, the big one is the stock price itself, stuck near those lows. Q4 results missed estimates and were down year over year with management citing delays. That SensiML strategic review, that could be seen as an admission something didn't work out. And that data security incident from last year still kind of lingers in the background.
So a mixed bag of news. What do the actual trading indicators tell us? Short interest, options activity.
The trading indicators really paint a picture of a battleground stock. Lots of tension, lots of speculation. First, short interest is high.
How high?
Over 2 million shares shorted as of late March 25. That's like 12.7% of all outstanding shares, and maybe 14% to 17% of the shares that actually trade freely the float.
That's a significant chunk. A lot of people betting the price will fall further.
Definitely shows strong bearish conviction from some segment of the market.
What about days to cover? How long would it take shorts to buy back shares?
Also high, between 11.5 and almost 15 days.
Meaning?
Meaning if the stock did suddenly rally, it could take shorts a long time to buy back shares to cover their positions, which could potentially fuel a bigger price spike, a short squeeze.
Yeah.
The potential is there.
Interesting. And options market activity? Bullish. Bearish.
Volatile. Definitely volatile. Implied volatility is way up there, 85% to 98%. High of IV rank a percentile too, suggesting traders expect big moves. But the put-call ratio is low.
Low, meaning more call option activity than put option activity.
Yeah, based on open interest and recent volume, the ratio is like 0.25 to zero point 0.3, sometimes a bit higher on volume days, but still generally low. Typically, low put-call ratios suggest more bullish sentiment among options traders, more people betting on a price increase than a decrease.
So you've got high short interest showing bearishness, but low put-call ratios suggesting bullishness in the options market, all while everyone expects high volatility.
Exactly, it's polarized.
Uh,
Total disagreement on whether this turnaround story is real makes it prone to sharp moves either way, a classic battleground.
Okay, let's peel back the onion further with Chapter 5, ownership structure.
Yeah.
Who actually owns QuickLogic?
Right, stakeholder analysis. Institutional ownership is pretty significant. Direct filings show institutions own maybe 34%, but if you aggregate data, it could be closer to 58%.
So big money managers own a majority of the company.
Seems like it. A majority of the float, maybe around 63%.
Who are the big names holding shares?
You see the usual suspects, the huge firms like BlackRock and Vanguard, but also some more specialized investors like Herald Investment Management, Geode Capital Management, and Taylor Fragan.
Have they been buying or selling recently?
Looking at recent filings, Herald seems to have bought more. Taylor Fragan trimmed their positions slightly. BlackRock and Vanguard, just minor increases, likely index-related adjustments.
So index funds provide some baseline ownership, and the active managers are probably there for that niche tech or turnaround story.
That'd be my guess. There are about 100 to 150 institutions holding shares in total.
What about the folks inside the company? Management, directors, how much do they own? And what have they been doing?
Insiders own about 7.85% of the shares. And here's that point we flagged earlier. Insider transactions over the last 12 months have been heavily skewed towards selling.
Selling, how much?
Something like 19 sell transactions versus only 4 buy transactions. Net result, insiders sold off over 158,000 more shares than they bought.
Who is selling?
Key people. CEO Brian Faith, CFO Elias Nader, CTO Timothy Sachs, Director Sue Taus. Some of these were under those preset 10b5-1 plans, but the overall trend is clearly net selling from the top leadership.
That definitely contrasts with the bullish analyst ratings and the fact that institutions own a fair bit. What do you make of that insider selling?
It's never a great look, is it?
Yeah.
Could just be personal financial planning, diversifying assets, or it could signal they think the stock is fairly valued right now, maybe not expecting a huge jump soon. Or, less optimistically, maybe a lack of deep conviction in the near-term upside. Hard to know the exact reason, but the pattern is clear and worth noting.
How concentrated is the ownership overall? Is it just a few big players calling the shots?
It's reasonably concentrated among those top institutions and the insiders. Means that big buy or sell decisions by 1 or 2 large holders could definitely move the needle on the stock price and volume.
Okay, last piece of this chapter, corporate governance. How is the company run from a board perspective? Are shareholders protected?
They have a classified board. Directors serve staggered 3-year terms.
Pros and cons to that, right? Stability versus making changes harder.
Exactly. Provides stability, but makes it tougher for shareholders to overhaul the board quickly if they're unhappy. On the plus side, they do have an independent chairman, Michael Ferrace, which is good governance practice. The board has the usual committees, audit, compensation, etc., detailed in the proxy.
Any recent board changes?
Yeah, Radhika Krishnan stepped down in March 2024, so the board size is down to 6 members now. Executive pay details are in the proxy statements, and shareholders get a say-on-pay vote.
What about shareholder rights generally?
Seem pretty standard. Annual meetings, voting on directors, auditors, equity plans. Importantly, no dual-class shares, so voting power is generally aligned with economic ownership. They have a code of conduct, follow NASDAQ SEC rules.
So overall governance picture.
Standard structures are mostly in place. But that classified board plus the long tenure of some executives we discussed earlier could lead to inertia. And ultimately, the persistent lack of profitability makes you question how effective the governance has truly been in driving long-term shareholder value. The mechanisms are there, but the results haven't followed consistently.
Right. Let's bring much of this together in Chapter 6. Risk assessment, using a SWOT analysis framework. Strengths, weaknesses, opportunities, threats.
Okay, SWOT, based on everything we've discussed, let's break it down. Strengths, definitely their specialized IP, the eFPGA and red hard tech. The open source strategy is interesting. They have those strategic government contracts, being fabless keeps capital costs down, and that experienced technical leadership.
Got it. Weaknesses.
Well, the big one, the history of financial losses, the weak balance sheet, high debt. They're just small compared to competitors. Revenue is volatile. Execution risk, can they actually deliver on their strategy? And being fabless also means dependence on manufacturing partners.
Makes sense. Opportunities.
Huge markets potentially. FPGAs, eFPGAs, edge AI, defense, all growing areas. If they execute, they could grab niche share. More government spending could help, maybe things like the CHEPS Act. The rise of open source hardware is an opportunity, chiplets too. And eventually, maybe royalties from all that IP they're developing.
So, potential upside if things go right. And finally, the threats.
Intense competition, obviously. Those big guys have way more resources, their own financial instability needing more cash, potential dilution. Cybersecurity is a real threat, as shown by that breach. Geopolitics, supply chain disruptions, huge risks for any semiconductor company now.
Plus export controls, tariffs.
Right. U.S. export controls, U.S. tariffs, potential trade wars, and just the sheer speed of tech changed the risk of their stuff becoming obsolete. Lots of external pressures.
Okay, that's a comprehensive look at the risks and potential. Let's move to Chapter 7, our brief conclusion, and we'll reveal that end hook. So wrapping up this deep dive on QuickLogic, what's the bottom line?
Well, it's definitely a mixed bag, isn't it? You've got some really compelling technology in potentially high-growth markets. That rad-hard stuff for defense is genuinely interesting. The government contracts provide some validation, but yeah, those strengths are seriously weighed down by the financials, the consistent losses, the debt, the cash burn. It's hard to ignore, and there's significant execution risk. Can this management team, despite their experience, actually turn this ship around and achieve sustainable profitability?
So, feels quite speculative at this point.
Highly speculative, I'd say. The technology is there, the potential markets are there, but the financial foundation is shaky, and the track record doesn't inspire huge confidence yet.
And for you listening, hopefully this detailed look gives you a solid foundation for your own thinking. It's complex, clearly lots of moving parts, definitely warrants more digging if you're considering it.
Absolutely. Always do your own homework. Now, for that final thought we wanted to leave you with, that end hook.
Let's hear it.
Okay, think about this. The semiconductor industry requires massive amounts of capital, constant, extensive R&D just to stay relevant. So the question is, can niche players like QuickLogic, with their current financial reality, truly thrive long-term on their own? Or are they ultimately more likely to be snapped up by a bigger fish looking for their specific tech, an acquisition target? Or are they perhaps just destined to keep struggling, trying to reach that sustainable profit level?
That's a really fundamental question about industry structure and the viability of smaller, specialized players in such a capital-intensive game. Definitely something to ponder.
It really is. And that brings us to the end of this deep dive on QuickLogic Corporation. If you found this analysis helpful, if you want more deep dives into companies and market trends,
please subscribe to the Stock Analytics AI YouTube channel. We'd love to have you join us for future explorations.
Yep. And just a reminder, we've put links to the sources we used, financial reports, articles, data providers down in the description below, so you can check them out yourself.
Please do.
And finally, the important bit. Remember, everything we discussed today is for informational purposes only. It is absolutely not financial advice.
Always do your own thorough research. Consider your own circumstances.
And definitely consult with a qualified financial advisor before making any investment decisions.
Thanks for tuning in.